that.
Across town at the Treasury Department, they just released the latest monthly budget report. Steve Liesman with the headline. Steve?
Hey, Kelly, yeah, the U.S. Treasury saying that the deficit is up to $1 trillion in April, that is. That's up 23% fiscal year to date, but it was a good month. The surplus was up $258 billion in the month of April. That is a surplus, and that's 23% better than a year ago. Still, the overall fiscal year to date is deficit. Big news here, the tariff revenue rising to $16 billion. I calculate that's almost $200 billion at an annual rate. And it looks to be the highest we've ever seen. We're waiting for confirmation from Treasury, but my data shows that this number on tariff revenue of $16 billion is a single month record, almost double the prior month record of $9.1 billion. Again, waiting for confirmation from Treasury. Spending was up 4% in April, 7% year to date. Receipts up 10% in April, 5% year to date. Individual tax refunds. Now, this is a good number here that is potentially significant. That was up. Those refunds were up 8% year to date. Sometimes that has an influence on consumer spending. And then interest on the public debt. You did have a downdraft in yields that was down 1% in April, but they're up 10% year to date. Brian.
Okay, a lot of headlines there, Steve. So if you had to use the Liesmanator, we'll call that's your filter, right? What would be like the main one or two takeaways on all these headlines?
I would say one, still an awful lot to do if you want to get control of the deficit. It was a good month in April. There were a bunch of adjustments back a year ago that defy the amount of time you have in this show and the next two shows to actually explain it. That's one. And two is those tariff revenues were significant, and they'll remain significant according to a new estimate that's out there from the Yale Budget Lab. Even if you were to back out those high China tariffs to where they are now, they will remain significant. So it's a big number that's being paid. And I like this idea of the refunds being high. If I could add a third one, that could help consumer spending at a trying time for the consumer. Mr. Sullivan.
And Steve, could I ask you a question? I'd love everybody's opinion on this. Does the deficit is so large, it's so much worse than it used to be. I've seen projections, who was this from, Zizas at Morgan Stanley, that the deficit's going to be 7% because of the Trump tax cuts and so forth. Does it even matter? I mean, what would the level of the 10-year be if we had a 3% deficit? Do you think it would be significantly lower, or is it even about that? Like, I can't figure it out.
Well, let me give you just a very small touch of history, which is that I had for many years contended that people were way too excited about the deficit level and that the capacity of the U.S. to borrow was quite a bit higher. When we approached and neared the 80 to 90 to 100% range, and I guess we're above that now, percent of GDP, that's when my concern rose. And it rose because we were running those high deficits at a time when the economy was expanding. And I was concerned about, and I remain concerned about, our ability to help the economy through federal spending in a downturn. So that's where it matters to me. I do not doubt the ability of the government to fund itself, if that's your primary concern. But that's like saying, how concerned are you about Armageddon?
Right,
At the margin, it matters, and it matters how much we spend on our interest. That matters because that means we have to make poor choices elsewhere for otherwise helping people or investing in the economy.
Do we, though? I guess that's my point. It feels like at this point you can have your cake and eat it, too. You can have high interest costs. You can have high Medicaid costs. You can have high everything. You can have 7% deficits. And the stock market's up to basically all-time highs again. And it just doesn't seem to matter, except maybe for bond yields.
Kelly, we can have us a high time if we want. But, you know, and ask Brian about that reference if you like. But The issue there is that it does preclude other things. There's an opportunity cost to all this. Yeah, we can do it, and it's gonna be expensive. When we start spending the kind of money we're spending on interest, it's time to have to get control of it. And I'll also say, we don't actually have to get control of it as much as we probably have to show the market that we have control of it.
Well, once in a while, you get shown the light in the strangest of places if you look for it right.
Thank you, Brian.